Now that we're in a technical recession and every investor left and right is losing money in the markets, here's how you can feel better about it. Facebook spent about $10 billion on the metaverse, and all they got was this selfie of Mark Zuckerberg. Oh, hi, Mark. I found the new slogan for the metaverse: minting millionaires out of billionaires. So in today's video, I want to share with you my passive income strategy that is arguably one of the best investment strategies in the entire stock market, especially during times of a recession. So I'll help break everything down as simple as I can. I'll give you an income breakdown of my dividends, and then I'll share with you some juicy new data about what happens to dividend investing in a recession. It's going to be awesome, especially if you're a nerd. Also, there are no courses I want you to buy, no mastermind groups to sign up for, and no email lists to join. So this is my personal situation. This is my stock portfolio. I also have one with Webull, which is just my random account with random stocks that I got, and of course my retirement account with M1 Finance, which is my Roth IRA. Now, I wish that my Robinhood account, my taxable brokerage account, was inside of my Roth IRA, because that way when I sell my stocks, I would not have to pay any taxes on this. But because I started a little bit later and I didn't have a Roth IRA, is why this account grew to where it is. Now, another reason why it's also as juicy as it is because I've been investing since about 2014, so I've had a lot of time on my side, and because I invest most of the money that I make into my portfolio, most of which, by the way, comes from YouTube, not from investing, because I'm not an investing guru, but luckily investing is way easier than the gurus like to make it seem. Now, so far, my dividend tracker shows that I've made $6,701 this year, and one of the months this year, I've almost cracked $2,000, which I'm really proud of, so I'm almost there. Now, as a general rule of thumb, if you want to know how much money you need invested in a portfolio like this to live purely off of the dividend income, what you do is you take the amount of money that you want to make per year. So let's say it's $40,000 a year. You would take this number and then multiply it by 22 or by 28. So if you multiply 40K by 22, you get $880,000. If you multiply it by 28, you get $1.12 million. So that's the range that your portfolio needs to be to generate $40,000 per year indefinitely. Now, you also need to have your dividend yield, which is this number right here, to be between 3.5% and 4.5% across your entire portfolio. Now, for my personal situation, my tracker shows that if I assume that my dividends will grow at the exact same rate that they have been, which is 2.8% per year. And if I continue reinvesting all those dividends that I just showed you every single year, rather than spending it on random things I don't need, it could boost my growth by an additional 3% per year. And if I assume that I continue investing at my same exact pace, that I could be making $157,000 per year by 2042, which is only 20 years from now, which I know sounds like a really long time from now, but the truth is that this is time that's going to pass anyway, so I might as well set myself up with a comfortable income in retirement. So that's my short little dividend income update. Now let me share with you what happens to all of this dividend income in a recession. It's really, really cool. And then I'll tell you the only things you'll ever need to know when it comes to investing. So I'm excited. Let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the magic. And speaking of magic, I haven't done one in forever, so check this out. It's the latest one I've been working on because investing is kind of like taking this dollar, and with the right amount of time and the magic of compound interest, you can transform it into a little nest egg. Huh? Little dad joke humor for you? Smash the like button though, because smuggling this Kinder Egg into the US was a pain in the ass. Alright, so let's talk about dividends, because one of my investment goals is to retire just purely on dividend income alone. And remember, dividends are paid out from the cash flow of profitable companies. But sometimes I worry that what if I retire in a recession where there is no cash flow? What would happen to my dividend income? What's gonna happen to my nest egg? So I wanna share with you some data that shows what happens to all this dividend income in times of distress. What I found overall is that dividends are a lot less volatile than the broad stock market, meaning that when there's times of hardship and there's a recession, dividend stocks tend to fall less hard. But when there's times of economic prosperity and growth, they also grow a little bit less. Here's an example. Here's what the stock market looks like between the year 1900 and 2018. All you have to pay attention to are these peaks and valleys. And here's what the dividend growth looks like from that same time period. So what we're looking at is the difference between between those two, and you can see that the dividend growth data has less peaks and less valleys, which means it's a lot smoother. Now, I also realized that in the last century, a lot has changed to society and the stock market, so let me compress that same time frame, show you that same thing from a little bit more of a recent time. So this right here is the stock market from 1968 to 2018, and this right here is dividend growth from that same time period. And the data shows that the price of stocks is twice as volatile as the growth in dividends. Completely makes sense because in the short term, no one knows exactly what the short-term direction of a company is, which is why the stock prices fluctuate as much as they do. But we know that in the long term, companies tend to become more profitable, and therefore people that hold on to their stocks get rewarded in the form of dividends. Now, if we look at times of a recession specifically, which you can see here on the left where stocks have dropped more than 20%, you can see in each of these cases, the change in dividends is nowhere near how much the stock market went down by. And in some cases, the dividends paid out went up instead of going down. The point is, dividend investing can be a really great way to invest in the stock market during volatile times like we have right now, where the market has no idea where it wants to go, which is why we have these crazy ups and downs. Now, the downside, I would argue, to dividend investing is that you will make less of an overall return if you were to compare it against something like investing in a broad market index fund like VTI or VOO. Dividends will make less, but I will argue that dividends are a lot less stressful. The downside, though, is that you need a lot of money invested in your portfolio to live just off of your dividends. But the upside, I would argue, is that it taught me to live way below my means and invest the majority of my income. So those are some of the pros and cons, but now let me share with you the only things you'll ever need to know when investing in a recession. All right, so here are some fun investing truths, and I'm sorry if you've heard some of these before, but I feel like now more than ever, when the economy is in a recession, people tend to make some desperate moves where they YOLO a majority of their money into meme stocks, hoping to double and triple their money, and then they end up losing most of it. And that's why the first simple truth is this graph right here, which shows over the last 200 years, the stock market has outperformed everything else in terms of real returns when factoring inflation. And I like to compare the world of investing to the world of fitness, nutrition, and weight loss, because I've known people who spent thousands of dollars in search of the magic pill that will make them lose weight and that'll make them fit, but the reality is it just means going to the gym, setting good habits, and eating healthy, and doing that consistently over and over again. And the same is true of investing. There are no magic pills. There are no stock courses you can buy, no magic money managers that'll make you more money, no stock picks that people can give you that's gonna 10x your money in a short amount of time, because it doesn't exist. Unfortunately, most people won't figure that out until they've spent decades looking for the answer. That's why the second truth is that the average investor will only make 2% on their money, which is way less than the stock market is supposed to make. And to prove that this is true, there's a recent article that came out by the CNBC which shared that only 1 in 4 Americans think that right now is a good time to invest in the stock market. And that's because most people's idea of good investing is to buy low and sell high. So they're always trying to time it. And that's why 65% of Americans are saying that they're leaving their money out of the stock market in fear of investment losses. And that proves that most people have no idea what good investing is supposed to look like. There is no good time to invest in the stock market. It's all the time consistently. Just like there is no good time to go to the gym. It's all the time consistently. The third truth about investing is that investing never goes up in a straight line like you would imagine it to. In some years, you have to be prepared for the market to drop by as much as 30, 40, 50, and even upwards of 80% in some years. It's crazy, but that's how it works. And during a 20-year period of investing, it averages out to be between 8 to 10% growth. But because people don't know that, they get so scared and they panic when they see a 30% drop that they sell everything and they sit out of the market, which is a really bad idea. And the fourth truth of investing is that there will always be some smart-sounding reason to sell, whether it's a recession or interest rates going up or a currency crisis or someone telling you to sell. Like right now, a good reason to sell is maybe the Chinese economy falls apart, or this chart right here, which compares stocks from today and stocks to 2008. And this implies that the stock market would need to lose another 63% from today's levels. And that sounds scary. It sounds like it makes perfect sense, but chances are, if you went through with it and you sold your entire portfolio, here's what might happen. Over a 20-year period ending on December 31st, 2021, the S&P 500 returned an average of 9.5%. 3% per year. But if you missed the top 10 best days of the stock market, your return would have dropped to 5.3%, which means missing those 10 crucial days, you would have lost on about half as much as you deserved. And that means that sometimes doing nothing is literally the best thing you could do. So just remember that the next time you hear someone tell you why they sold their stocks, because it'll sound like a good idea, but chances are it won't be. Now, I have a couple more investing truths that I think are even better. The sixth truth about investing has to do with politics. Some people seem to think that the stock market does better when the Republicans are in control of the government. And some people seem to think that it does better when the Democrats are in office. But the truth is that the stock market goes up regardless of who's in power, because the economy is so much bigger than any presidential or political influence on it. And that's why the stock market goes up regardless of who's in power. The point is, don't try to use the political cycle to time the market, because in the long term, it doesn't really work. All right, the seventh truth about investing is to ignore economists. That's because there's a little funny physics joke about economics that goes like this. The first law of economics is that for every economist, there exists an equal and opposite economist. And the second law of economics is that they're both wrong. And that's why I don't make my own predictions about the market. I try to make sense of it and I show you how I'm investing, but I'm not gonna make my moves based on what I think will happen, even if I think I'm right, because it's not worth missing those top 10 crucial days. Now, the eighth truth of investing is that the earlier you start, the faster you can get to that 20-year period and hopefully end up with more money than you started with and more time on your side to compound your money into millions to retire with. But those are all the objective truths that people just can't argue with. But there's also a ninth truth about investing that's a personal truth to you. And this is where the internet fights and bickers over which investment strategy is the best. The truth is, there is no best. They all cater to a different kind of person and a different kind of goal. For example, if you're somebody who likes to invest into real tangible assets you can touch and feel, you might want to be a real estate investor. But maybe you're somebody who doesn't want to manage tenants and you don't want a full-time job, so maybe you want something more passive, so you invest in the stock market instead. So you buy broad market index funds because you heard that over the long term they produce the best results, so you buy VTI or VOO and you hold on to them for more than 20 years. That's a cool strategy too, but maybe you don't want all that volatility and you don't trust the market as much. So maybe you buy mutual target date funds, which over time shift from stocks to bonds as you get older. Or maybe you're already older and you want to protect your wealth because you've already accumulated a lot of money, so you buy bonds exclusively and that's all you stick with. Or maybe you feel better about investing in the stock market because you want to be paid that cold hard cash and you're okay with giving up a couple percentage point returns because you feel like this is a much better result for you. Or maybe you don't trust the stock market at all, so you invest all your money in yourself and building yourself a business. Or maybe you want to invest in alternative assets because you don't understand any of that stuff, so you want to buy some crypto. The point is, there's no right answer and it depends on the person and the situation. And that's why finance and investing is called personal finance, because it is personal to all of our personalities, our goals, and the things we're comfortable with. There is no best. At a certain point, it just becomes subjective. Anyway, sorry for the crazy rant, but if you made it this far into the video, let me share with you a quick few highlights of what happened in the market last week. All right, so the biggest story that happened last week is that the housing market is finally starting to cool down, with existing home sales falling 6% and 63,000 homes that went under contract, which is about 15% of the entire real estate market, are now getting canceled. And that is the fastest rate of cancellations since the Roni started. Now, nationwide, inventory levels are starting to climb, and that's why the NAHB, the National Association of Home Builders, just recently declared that the housing market is already in a recession and falling fast, which is why their confidence metric is down for the 8th straight month in a row. And also last week, the market found out in the latest FOMC minutes meeting with Papa Powell that the central bank has no plans to slow down interest rate increases, which means the real estate market is probably going to suffer a little bit more this year. But what's crazy is that dividends paid out in the residential sector, or REIT stocks, is actually up more than 10% this year. And mortgage-backed REITs, the dividends have increased more than 15% this year. And that means that even though we're in a technical recession, dividends in relation to the real estate market are still up, which is why, proving my point, dividends can be a really great way to diversify diversify your income even in tough times, which is why I'm still reinvesting in them. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this link right here. Don't forget to take it offline onto a cold storage wallet, but grab the money while it's still there. In the meantime, grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.